Whole life insurance is permanent, where the coverage duration covered for insured persons and their lifetime. The cash value grows over time that can earn interest, and the death benefit is a payment guarantee to beneficiaries if the insured person passes away. However, the term life insurance is fixed in a coverage duration, which is only for a term period. Term insurance does not accumulate cash value, and the death benefit is paid only for a specific period when the insured person died with the term. If the policyholder leaves the term, they will not receive any return on the premiums paid. Whole life insurance provides coverage for the entirety of the insured person's life, and also the policyholders pay fixed premiums that never increase. Furthermore, it guarantees cash value accumulation based on the cash value component that grows over time. Last one is the insurance companies will distribute dividends to eligible policyholders. However, whole life insurance can be more complex and harder to understand the policies. The premiums are also higher than term life insurance. In addition, the death benefit and premium amount are usually fixed and cannot be adjusted. Although it has cash value accumulation, the return is generally lower compared to other financial instruments. Term life insurance is typically more affordable compared to other types of life insurance. It offers flexibility in both policy duration and premium payment frequency. It also allows policyholders to convert their term policy into a permanent life insurance policy. Term life insurance can be customized to align with life stages, which is suitable for individuals. However, premiums of term life insurance increase significantly with age because they pose a higher risk to their insurance companies. It is a pure protection plan that does not build any cash value or savings over time. The insured is not longer covered once the term ends, and when the policyholder stops paying premiums, the policy lapses and no money is returned.
In this section, we focus on performing a financial comparison between term life insurance and whole life insurance for a 35-year-old non-smoker seeking $500,000 in coverage with a term policy duration of 20 years. Our main objective is to compare the total cost and financial benefit of each option over this 20-year period. To do this, we consider two key financial aspects. First, we calculate the total premium paid over 20 years for both policies. Second, for whole life insurance, we estimate the cash value growth by assuming a 3% annual growth rate, since whole life policy often accumulate value over time. This comparison gives us insight into the cost effectiveness and long-term value of each option.
Next, I will be comparing two common types of life insurance, which are term life insurance and whole life insurance. For the monthly and annual premiums, term life is significantly more affordable, costing $39 per month or $468 per year, while whole life costs $571 per month or $6,852 annually. Then, when we look at the total premiums over 20 years, term life adds up to only $9,360, where whole life totals $137,040. Then we consider the cash value. Term life has no cash value at all, but whole life builds savings over time. Using a 3% annual interest rate, its future value after 20 years is estimated at around $184,115.81, making it a valuable long-term financial tool. In summary, term life suits short-term needs with lower costs, while whole life is ideal for long-term planning with cash value benefits.
We will discuss the importance of insurance in family financial planning. Imagine a 30-year-old young parent with small children. Their primary goal is to provide financial security until their children are independent. However, this goal comes with significant challenges. The cost of raising a child in Malaysia is estimated to range between Rm 400,000 and Rm 1.1 million, according to AIA Malaysia. Additionally, many families carry other financial burdens such as mortgage, with monthly payment between Rm 2,300 and 3,200 for a Rm 500,000 loan for CIMB. Car loan and other expenses further strain a family budget. In such a scenario, careful financial planning is crucial.
Based on the needs of a 30-year-old parent with small children, their priority is to shield the family from financial instability and ensure children are supported through their growth years. Therefore, financial planning is crucial. After analyzing available options, term life insurance suits the 30-year-old young parent. Term life insurance stands out because of its lower premium structure. For example, a 400,000 ringgit coverage for 49 years costs only 764 ringgit per year, which is significantly more affordable than whole life insurance, which offers cash value but requires higher premiums. Additionally, term life insurance provides coverage for a set period, such as 20 to 30 years. To ensure the protection until children reach adulthood, it also offers flexibility, allowing conversion to another policy if health conditions change. In summary, term life insurance is cost-effective, structured to meet family needs, and adaptable for future circumstances. For young parents seeking for financial security, investing in term life insurance is the most practical solution.